So tariffs, inflation, and the future of the dollar. Those are pretty big subjects. And I'm going to try to cover at a very high level what we think about those things in the next 15 minutes or so. Of course, I could talk about these things for a few hours, but that's not going to happen. So, all right, so what is a tariff? There's actually been debate. I saw a debate between Scott Bessent, the Treasury Secretary, and somebody in the media the other day about what a tariff was. Is it a tax? Is it a duty? Technically, it's just a tax on companies that import goods from other countries, right? So that's ultimately what it is, right? So China produces something, because China produces pretty much everything for everybody. They send a good across the sea. It comes into American ports, and companies here that are planning on selling these goods then have to pay the government a fee, and that fee is a tariff. So that's technically what it is. The question, though, is that passed on to the consumer? Like, who ultimately pays that fee, right? So technically, the import company pays it. Practically, though, it's really all it's doing is increasing the cost of bringing that good to the market. Okay, that's fundamentally what a tariff does. It's certainly paid directly from an import company to the government, and we can see over the last, say, 5 or 6 months, revenue to the government has increased quite a bit, somewhere in the range of $30 billion a month that the government's pulling in from these tariff fees. But the question is, though, how does that actually get absorbed in the structure of production? Where in the economy does that fee end up being absorbed? And many economists, especially at the Federal Reserve, which is a little bit surprising, but many economists assume that adding tariffs are what they would refer to as inflationary, meaning prices are going to go up for consumers like you at the end of the day. You guys are going to end up bearing the brunt of these tariffs. And the reason for this is they have a concept of market pricing called cost plus, basically. And the idea is whatever it costs to bring a market to bear, then the end retailer or distributor is going to just mark it up at a profit margin of whatever they want. So if it costs $50 to bring a widget to Target, Target's going to look at that and say, we want 10% profit margin, so we're going to charge consumers $55. But that's not really how it works, because at the end of the day, consumers aren't looking at this and going, yeah, we're willing to give Target 10% profit, and we know it costs them $50 to produce it, so we'll pay $55. No, at the end of the day, a consumer is going to say, it's not worth $55 to me. Maybe it's only worth $40, right? In which case, those widgets don't get sold, right? So that's kind of how it really works. At the end of the day, the price is ultimately determined by the consumer at the point of consumption, and then prices work backwards from the point of consumption through what we call the structure of production. There's a great essay on this, if you want to look it up, that talks about the process of producing something as simple as a pencil and the process it goes through. It's by an old professor named Leonard Reed, and he worked for the Foundation of Economic, I don't know, it's called FEE. I can't remember what the other E is, entertainment or something, but that's not, nobody's entertained by economics. Anyways, he wrote a book called iPencil, or an article called iPencil, and basically he talks about the complexity of bringing all the raw materials that are developed into a pencil from beginning to end, and how complex that is. But the point is, where do the prices for all those intermediate goods and services come from? Do they come from the cost that people just arbitrarily associate with them, or are they determined by the end consumer, whatever consumers are willing to pay for the end product, and then they work themselves back? That's really what determines prices. And there's an old economist named Jean-Baptiste Say, and he was French. Don't hold that against him. He originally coined what has now become something called Say's law. Okay, Say's law is now often summarized as supply creates its own demand, which for a lot of people that means, well, if I just bring a product to bear in the market, then there will be demand for it. But that's actually not what he said. So here's a picture of J.B. Say. I like his forehead, probably because it looks like mine. He said this, okay? A product is no sooner created than it, from that instance, affords a market for other products to the full extent of its own value. Okay, that's what he actually said. Now, the key here is, what is the full extent of its value? Well, the value is in the eye of the beholder, or the eye of the consumer, right? So a consumer is only going to pay what they think something is worth. So you can bring something to bear in the market, you can produce something, and maybe the value consumers see is twice as much as what it costs you, in which case your profit margin is absolutely huge. What if you produce something and nobody wants to buy it for what it costs you to make? Well, in the olden days, your business would eventually cease to exist. You go out of business. Nowadays, we just lobby the government for a subsidy. Okay, but that's what actually happens, and that's why when we talk about tariffs, we don't see it as simple as it's just being absorbed by the import companies. The reality is it's much more nuanced than that, and the question is who actually absorbs those costs, okay? Now, this leads us to the next question. So will tariffs lead to higher prices, right? Are consumers going to absorb these fees down the line? And in order to answer this question, I think you would already know the answer if you paid attention in economics class, okay? Now, not your economics class, but Ferris Bueller's economics class, okay? Does it sound up?
Anderson. Here. Bueller. 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 Bueller.
He's sick. My best friend's sister's boyfriend's brother's girlfriend heard from this guy who knows his kid is going with the girl who saw Ferris pass out at 31 Flavors last night. I guess it's pretty serious.
Thank you, Simone.
No problem whatsoever.
Fry. Fry. In 1930, the Republican-controlled House of Representatives, in an effort to alleviate the effects of the, anyone? The Great Depression, passed the, anyone? The tariff bill, the Hawley-Smoot Tariff Act, which, anyone raised or lowered? Raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone? Anyone know the effect? It did not work, and the United States sank deeper into the Great Depression. Today, we have a similar debate over this. Anyone know what this is, class? Anyone? Anyone? Anyone seen this before? The Laffer curve. Anyone know what this says? It says that at this point, as at this point, this is very controversial. Does anyone know what Vice President Bush called this in 1980? Anyone? Something DOO economics. Voodoo economics.
All right, so
Is that how we're looking to you?
yeah, I know. I'm gonna scan the audience now and just make sure. Jim, stay awake. But notice what he said there. He referenced the Smoot-Hawley Tariff Acts. The interesting thing about that is Ben Stein, I guess, he's an actor now, but he was an economics major in college, and so when he showed up to audition for that role, they said, just teach on something you know. So he started talking about tariffs and the Smoot-Hawley Act. But what he brings up there is absolutely true. Okay, the Smoot-Hawley Tariff Act did not help us escape the Great Depression. In fact, it probably made it worse. So in 1929, it was enacted, but it diminished international trade. Okay, it set up trade barriers. There was less trading going on. It also hurt demand because it increases potentially the cost either to the importers or to the final consumers if that cost is passed on. And it's interesting, though, because after the Great Depression, tariffs trended lower for much of the next 80 years. So you can see here on this graph, and it's very small, I apologize, but I had to get in about 100 years. So the red line is the tariff rate, the effective tariff rate, okay? And the blue line is inflation. So what you can see here is in late 1929 and into the early 1930s, the effective tariff rate was actually increasing as the Smoot-Hawley Tariff Act went into effect. At the same time, inflation went from positive 3% down to minus 10 at one point. Now, I'm not saying that the tariffs caused inflation to fall to 10%. There were certainly other problems in the economy during the Great Recession, but certainly tariffs did not help with the problem. And if anything, they made it worse, okay? But over the next 80 years, what you'll notice is tariffs, so they got up to about, it's on this axis, it got up to about 20, and then they just trended lower for almost 90 years until recently, okay? And when I say recently, I don't mean in the last 6 months, although that's certainly true. You can see this spike here in the tariff rate. This is an estimate because tomorrow it may completely change, and everybody knows what I'm talking about, okay? But the best case, base case, is that the tariff rate may go from somewhere around 3% up to about 15%, okay? But what I'm talking about, though, when I mention recent, is actually back in 2016, 2017, 2018, during Trump's first term. He actually implemented tariffs on China back then, and not just China, but a few other countries. And so you can see it actually went from about 1% up to 3.5%, 4%, okay? The question, though, did tariffs lead to higher prices during that period? Okay, because that would be an interesting question to ask, if they do lead to higher prices. So the answer is yes and no. I know that's not very helpful, but I'll explain why in a minute. Okay, so price inelastic goods may see prices increase. So when you're talking about prices for goods that don't have an easy substitute, or something that people absolutely need to have, what happens is it doesn't really matter what the price is, people are going to pay it, okay? But the problem is when the consumer is not increasing their income, or they don't have capacity to absorb those costs, what ends up happening is the prices that do have elastic goods, okay, actually end up, price elastic goods actually end up seeing a decline, right? Because if I only have so much income and now I have to put more of my income towards one good, like gasoline or some widget from China that now costs twice as much, right? Then what do I have for these other goods that I might normally spend? Well, I'd have less, so I have to cut back on my spending. And so tariffs really, at the end of the day, they shift consumption and trade patterns. They don't necessarily lead to sustained consumer price inflation. And you know, as an artificial imposition, and I say artificial because it's the government just artificially saying we're gonna charge more, we're gonna increase the cost for these goods, upon a relatively free market, tariffs have an overall disinflationary impact. And I'm not really gonna flesh that out, but I do want to show you actually what that looks like. And so it's interesting, I have to point this out, it's interesting to listen to the Federal Reserve this year talk about how inflation, these tariffs that Trump has put on are likely to lead to increased inflation, when they actually know, according to their own research, that doesn't really happen, okay? So they actually came out with this research just a few months ago. This is the Federal Reserve Bank of St. Louis, and they went back to 2017, 2018, 2019 and looked at inflation and what happened when Trump took tariffs from 1% to 4%. And I know we're talking about a larger potential tariff increase this time, but that all the more reason to think it may actually be more disinflation or lead to lower prices. So what you see here, you see a broad range of different types of goods, okay? And there's a lot here. But the main point is these tariffs really went into effect kind of mid 2017. What you'll see is there's an inflection point where some goods started to go up, other goods continued to go down and maybe even sped up. But the overall, the black line here in the middle is the overall inflation rate. And that really it wasn't disrupted at all by the tariffs. In fact, it just continued to decline. Again, prices are still going up in that scenario, but they're going up at a slower rate. And so the idea here I'm trying to get across is that the tariffs didn't actually impact inflation or didn't lead to inflation in 2017, 2018. What we saw was inflation continued to go lower. Okay, so the question though is, can we trust the official inflation numbers that we have today? And a lot of people ask me this question because we're just naturally inclined to not believe the government. And I would tend to agree with you. But the interesting thing is I would say we can't trust the official inflation numbers. In fact, inflation is likely lower than the official inflation rate. I know that may come as a shock to some of you, and you may want to throw your pins at me right now, and that's okay. But let me explain what I mean by this, okay? The official inflation rate right now is about 2.9%. That means you're losing 2.9% of your purchasing power every year. The Federal Reserve thinks that's good policy. Okay? I think it's stupid, but that's the governance we have. However, if we strip out the BLSs, and when I say BLS, that's the Bureau of Labor and Statistics, okay? If we strip out the BLS's shelter component, what they consider our inflation cost for shelter, that means home purchases, rents, okay? They think that shelter is increasing at about 4% a year, but it makes up about 35 to 40% of the shelter data that they give. If you strip that out, then official CPI actually goes down to about 2.5%. Okay? If, though, we use market-based shelter indicators, and there are many of them out there that a lot of people reference, but if you look at rents, if you look at home prices, they're actually declining on a year-over-year basis, or at the very base case, they're flat, but many of them are declining. If you include them in the official inflation rate, we're actually closer to 1% official inflation, which is well below what the Fed actually thinks is a good idea, okay? I think it's great in a sense, the less purchasing power we're losing for the dollar, the better. But they actually are targeting 2%. And so potentially you could say the official inflation rate is possibly below their own target. This is interesting though. So the BLS collects about 90,000 prices each month, which sounds like a lot. Interestingly though, they estimate about a third of those. And I don't even know how you estimated price, but they have their ways. Anyway, so really they only have about 60,000 prices they're collecting each month, okay? However, there's a group of entrepreneurs that came out about 5 years ago. They developed a tool because they thought the BLS was lying about official inflation. They thought they were way undercounting official inflation, right? And there are a lot of people that share that sentiment. So they actually created it's a blockchain technology, but they inculcate into this over 100 million data streams daily. Okay, so the BLS is collecting 90,000 or 60,000 prices a month and estimating 30,000. They are bringing in 100 million data points every day to develop their own price index and to say, okay, here's what we think the official inflation rate is. And sure enough, for the first 2 to 3 years they were in business, so to speak, the inflation rate that they had was way above what the BLS was saying. So the BLS was saying we were at 2%, 3%, then it kind of got up to 9%. They were saying, no, we're at like 15 to 20%. At one point it was 24%. So they were right. But then a weird thing happened in late 2023 and 2024. Their price index actually just plummeted, okay? And currently, Trueflation is well below what the official inflation rate says. And it showed only a mild reaction to tariffs that came into effect a few months ago. So right now it's showing the official year-over-year inflation of 2.2, which is pretty close to the Fed funds or the Federal Reserve target. And you'll see actually here, it was down at 1.2% in April. Now it's come back up. You could say, well, that's probably because of the tariffs maybe. There's other seasonal factors involved. But at the end of the day, it's a still relatively mild effect from the tariffs, and it's still well below what the official inflation rate is. So I tend to think these guys actually went into business to prove that the BLS was lying, and now they're actually showing data that just says that the BLS is overestimating inflation. So I tend to think, there's reason to believe that they may be onto something, and this may be somewhat accurate. So inflation really isn't a problem. I mean, it's a problem, but it's not a threat to the dollar. Now, here's the other question that I get from a lot of people: is the dollar doomed? Right? So, are we at the end of the dollar? And this is in the news media a lot. It's a heavy narrative, and I would say no, not yet. We actually are very bullish on the dollar. We think the dollar is going to go up, but we still like gold. And I say this because I want people to understand. I think there's this common misunderstanding that people think you can't be bullish on the dollar and be somebody who has an affection for gold. Usually people who are getting into gold love gold because they think the dollar is going to go to essentially a zero value at some point here soon. We don't think that. I just want to go out and say we love gold. We think a monetary system based on gold would be way more ethical, way more productive than the one we have. There was another French economist, and he was half Irish, so I guess that means half of what he said sounded beautiful, the other half you couldn't understand. But his name was Richard Cantillon. Okay, Richard Cantillon. He was he lived 250 years ago or so, but he was the first one to come up with what is now called the Cantillon effect. And what he did was he described how governments or banks, financial institutions that can create dollars out of thin air through credit expansion, these companies give that money to someone in particular first, okay? And the first person to receive that money benefits the most, okay? Because they actually receive money, and now they can go out into an existing price structure and economy and buy things with more purchasing power. Who loses in that scenario? It's the one who gets the money last, right? Because now, over the transition period, they're going into an economy whose prices are adjusting, but they don't have the additional cash. And so this type of system is I would say it's inevitably doomed, but it's the system we have. And the reason we think the dollar is not doomed is because not only is the dollar our currency, but it's really the reserve currency of the entire world. And as bad as our budget is, as bad as the US economy is in some ways, it's still a beacon of light compared to the rest of the world. And so I just want to give you this illustration to show you. So this is the nominal US dollar index. So this compares the dollar to every other major currency, all the trading partners that we have. And what you'll notice is, this is over a 20-year period. But since 2011, I mean, it's been pretty consistently stronger against every other major currency. And this includes the Eurozone, includes a lot of the major Asian countries. In fact, it's appreciated about 40% since 2011. Now you can see there's a drop here. And every time you see a drop like this, guess what comes up in the news, right? The dollar's losing value, you know, get out of the dollar, buy gold. And I'm okay with buying gold. But this does not mean the dollar's doomed, okay? In fact, this was more likely because of Trump's tariffs. When he announced that he was gonna implement all these tariffs, what people did was they bought a bunch of goods. And when they bought a bunch of goods, they sent dollars overseas to get all these goods in the US. That flooded the world with dollars, and so it diminished the dollar exchange rate temporarily. We do think, though, that's kind of rolled over. So since July, it's actually back up a few percent, and we think it's likely to head higher. So last question, I'm almost done. Are foreigners selling US Treasury bonds? Because this is another narrative that comes out every few months, or occasionally somebody will say, China's dumping their Treasury bonds because they want to destroy the US dollar. Okay. It's just not happening, okay? And I laugh because the problem with this is the actual facts on the ground, okay? So here is, I clipped this from the Treasury International Capital website, okay? So they publish the results of all their bond auctions. We know the US government has to issue debt to pay for all the stuff they do. I'll just say stuff. And they have to issue a lot of bonds, right? They issue bonds a couple times a week usually. Well, this bond auction happened last Friday. Last Friday, they issued 30-year Treasury bonds, okay? So if people were concerned, if foreigners didn't want US dollars, if they didn't want US debt, it's highly unlikely they would come and buy debt that lasts the next 30 years in the US, right? Except they did, okay? So they showed up on Friday, and out of the $22 billion that we were issuing, it was chump change, 22 billion's hardly anything, right? Okay, out of the $22 billion that the Treasury offered, foreigners wanted to buy 16 billion of it, okay? So almost 80% they were willing to buy. Now they didn't get all that because the Treasury oftentimes doesn't award them all that they ask for. But they did give, and then they gave some to direct bidders and primary dealers. Those are domestic buyers. But the point is, overall, the amount of tendered offers was actually almost 2.5 times what the Treasury was offering. Now that's actually somewhat common. Pretty much every auction they do, there's always way more tendered offers than they actually will sell, okay? And so the question is, are foreigners selling US Treasury bonds? Like, it sounds good. People like to do that, especially when they're selling gold. But the question is it actually happening? And we would say no. And just one more graph. This is the Federal Reserve debt held by foreign and international investors. You can see from 2001, foreign investors held about $1 trillion, okay, in US Treasury debt. Today, they hold over $9 trillion. And to me, it doesn't really look like that's slowing down, okay? So the reason I wanted to bring this up is we answer these questions a lot, but I think it's important for you all to understand, maybe be able to decipher the difference between narrative that you're gonna hear on the news or from financial newsletters or whatever, and actual facts. And the facts are that the world needs a lot of dollars. The world needs a lot of Treasury debt, okay? It's not the system that I would design. I think it's actually ridiculous and it's unethical in many ways, but it's the system we have, okay? And so it's our job to make sure that we can help you profit from the system we have, not the system we would like to have.
Are cracks starting to appear? And they have an over-under on how long I'm going to take, and I'm going to win this sucker. All right, so, yeah, I know. Everybody has heard. So, all right, don't interrupt me, no. All right, so let me just start economically what's going on. And I have a couple of slides that are just really what I think are the most important items that are going on in the economy. Last month in September, the labor statistics had a revision of the March annual job numbers. They overstated the annual by over 900,000 jobs. That's not a small number. And the job numbers are continually getting lower. Okay, so that's, and remember, when the jobs aren't there, the spending is going to be lower. Okay? What do we see? We're seeing that the employers are adding fewer jobs. That revision, by the way, was the highest on record going back to 2000. We see younger workers who tend to lose jobs more quickly. We're seeing already a rise in their unemployment rate. And the slowdown continues as weakening labor demand. Hear that? I want you, you're going to hear a lot about the demand. It always comes back in economics. What are consumers, what's the demand? It's always, and then the supply will follow to meet that demand. So in labor, we're seeing the same thing. There's people who want to work, especially in the 18 to 25-year-old. They want to, well, many want to work. Okay. So asterisk, but there's not a demand for that labor. All right. AI spending. Who was it who had the question about AI? For those who don't know, AI, artificial intelligence. The issue we have right now, it's not at all that AI is going away or it's not useful. It is going to be a game changer. It's, does anybody really, it's one rabbit trail. What is AI? Can, steak sauce. No, A1. I like that though. I like that. Yeah, I like that. Okay. Can somebody top that? What is AI? Okay. How many people have used Google? Okay, search engine, right? And you could put in your question in Google today, and it'll provide you the first 5 pages in Google are going to tell you people who are paying sponsor ads on that, the answer to your question. But it's sponsored by whatever your question had to do with. Okay, that's really what Google is. AI is being used, such as you've heard of the term ChatGPT, right? Okay, I encourage everybody, if you don't have an account, get an account. And it's just like having a Google account. I mean, it's free, you don't have to pay anything for it. But when you ask a question, and it can be anything, how to do something, or history, or that's probably where Isaac got a lot of that information in history. Okay, he just said, and you can go as much detail, but when you say, ask the question, and you hit the button, it might take 30 seconds, but it scours the world, computers and data system, and it just brings you what the most consistent, correct, doesn't mean it's always right, but what I'm saying is it does a pretty good job. You need to write a report, you need to learn how to do something, it is, and it doesn't cost anything there. That's being applied in a lot of things. Pardon? Across everything. Yeah, across everything. Everything will give you more correct answers faster and cheaper than hiring some people to create a report or whatever. So I will just say that this also is going to be deflationary, okay? Because it'll eliminate certain jobs that were critical. They're no longer critical because computers can write reports. So that's the end of the rabbit trail on that for now, okay? But here's, and by the way, it's just like when automobiles came out, when replaced horse and buggies, when airplanes came out, all of these were really great and made significant. AI is going to be very significant. Our problem with it is right now, and by the way, in all those innovations, and including the .com, all of that innovation for every Microsoft, Oracle, and tech company, excuse me, there are thousands of companies that went bankrupt. And the problem we have with it is the expenditures on AI by companies in the US are projected now to exceed $500 billion in both 26 and 27. Now, what I find interesting is that's roughly the annual GDP of Singapore. By the way, Singapore is probably one of the wealthiest nations in Asia. The problem is the next one. But the Wall Street Journal just recently reported that American consumers are only spending $12 billion a year on AI services. Now, that's roughly the GDP of Somalia. Now, if you just internalize that economic difference between Singapore and Somalia, you get a sense of that huge chasm that exists. And really, it's between the vision and the reality of AI land, okay? So it's going to change the world. It's the most important story in the world today of change. But the numbers, they just don't add up. Now, OpenAI and NVIDIA, they are fueling what we call a web of circular deals. Now, Isaac and Joel, they're not old enough to remember the .com, all right? I think we have some clients who have been with me and remember the .com. That's exactly right. Well, there's a wave of deals and partnerships that are really escalating in today's markets, just beginning, that the AI boom is being propped up by the circular business interconnected transaction. Now, I tell you what, I'm gonna give you a much shorter way to know what is a circular deal. And I think if Joel said I can just do that, touch screen.
Not a touch screen. You gotta use that little keypad.
Oh yeah, keypad. Jeez. All right. All right. Thank you, Joe. All right, you ready? All right. Let's see if I. Okay.
Well, I only got 10, so here's 10, I owe you 10. Thanks. Hey, Mo, you owe me 20. Well, here's 10, I owe you 10. You owe me 20. Here's 10, I owe you 10. Here's the 10 I owe you. Here's the 10 I owe you. Here's the 10 I owe you. Good, now we're all even.
Okay. That's circular dealing. And I like, this is a professional investor, and he was just recently interviewed by the Financial Times, and this is what he had to say. I have to say the words vendor financing do not carry nice reflections to somebody of my age. He's 65, so very young. It's not quite like what many of the telecom suppliers were up to in 99 to 2000, but it has certain rhymes to it. So there's our concern. The people who are on top, they may not always be on top. So it's going to play out and it's going to change the world. But as you're going to see, the price people are paying for this stuff. And here's our concern. And I'm going to go through this very quickly. We know that historically, starting yields anchor our long-term returns for and cash flow and income for our clients. And the high stock market concentration, and what I mean by concentration, I don't have a pointer here, but today, the top 15 companies in the S&P 500, they make up now 44% of the market value. The prices are so high. 56 represent the other 485 companies. That's a problem because when the S&P 500 goes down, it's taking a huge amount of value from that. This has been going on now for a few years. And we feel it's very dangerous to wipe out capital. And the second issue here on these prices that people are paying today for those 15 companies are so high that the 12-month yield on the entire 500 is only 1%. Let me tell you what that actually means. You could own $5 million of stocks. That sounds pretty good, huh? You feel like you would be rich? Do you know that $5 million of stock in the 500 would generate $50,000 a year income? 5 million, okay? Can you see the issues we have with that? This is what we call, and I've seen it in my 40 years in the industry, I've seen 3 major downturns. People have forgot about the dot-com. Can anybody here tell me the percentage that the NASDAQ went down from 2000 to 2002? Any percentage? Remember? 83%. Now, and it's with that 1% dividend, it's not that they are cutting the dividends, it's because the price got so high that people are not being compensated really for the risk they're taking. And that's what we call a Wile E. Coyote moment. It's because, remember, just like the cartoon, the coyote runs out and gets beyond the ground and realizes he's in midair and there's really nothing holding it up. I look at that 1% dividend, the yield, and I say, there's a lot of air between what fair value is. And that's what's going to happen in AI. But the prices people have got it up, they just think there's no end to it. All right. Which has the greatest impact on your spending power? Is it having cash flow, stable, reliable cash flow, income? A lot of people here are receiving cash flow. We have a few young guys and gals here, but most are looking, and by the way, all investing is The young guys, you're sitting next to it, is about generating income. I don't care if you own real estate, you own rental properties. The key, what you use it for, is to generate cash flows. Bonds are the same way. We generate cash flow. Stocks, they used to pay cash flows, but the prices get too high. So what I want to remind you of, I know most of you have heard this before, but I want to remind you that successful investing is counterintuitive. The higher the price, let me back up because I do want to finish that. It's counterintuitive because the most successful investors, like Warren Buffett, they put a great deal of emphasis on the relationship, on the price they pay for anything, any investment today, and the cash flows they can expect in the future. Doesn't that make sense? Okay. So we know, very simply, the higher the price an investor pays today, AI stocks, the lower the future rate of return can expect, and the greater your downside risk. The lower the price an investor pays today, the higher the long-term rate of return the investor can expect, and there's very smaller downside risk. Now, let me show you, let's see where we are here. I want to show you, this is an actual client statement. We just took somebody who had $500,000 client. We redacted everything, so you can't see. But what I want to show you, since October in 2020, the pandemic, right? The year of pandemic. And the government once again took interest rates down to 0. And they stayed down throughout the pandemic. And we had clients who cannot live on 1 or 2%. And so when we started in 2020, and this is just right before we began working with Simplify to find alternatives to the traditional stock, traditional bonds that can help our clients. So in the yield, this is what I want you to see here. The yield, that's how high prices got on bonds before things came down. And the yield was 2.1% on 680,000, okay? And which isn't good. That was a problem, okay? So I want you to see now, in 3 years, what we did, October, and this same client, October 23 now, we were able, and this was during the time like Silicon Valley Bank, they were, the technology industry needed capital, and they had a run on their bank, and they held all these long-term treasuries, and they had to liquidate $9 billion of bonds, treasury bonds. And we were looking at that, gosh, we could buy treasury bonds at a 70% discount, but nobody wanted to touch them, okay, because of the inflation that was beginning to happen. So anyway, through rabbit trails, sorry, in 23, we increased from the 2.1, not a big deal, we got it up to 4.4. That still wasn't good, but I want you to see from 23 to 25, I would have put October 25, but do the math, we're not there yet. Okay, so I had to use the exact same statement, and each of you that have a current income strategy, which are most of the people in this room, if you look at your state investment, if you do the math on how much income, look at this, 49,000. Now remember, that's almost $50,000, and to get in the stock market, you'd have to have $5 million of stock with prices that are very risky at coming down. We've really doubled the amount of cash flow for our clients, and it's largely because of the tools we have today that we can access what are very much like insurance company and returns, if you will, or income, and take premiums, and it is really bolstered. So we're taking on less risk with the alternatives and getting higher cash flows for you. Key takeaways from today. I summarize Isaac's there. Tariffs are deflationary, and the near-term future of the dollar is bright. Alternative investments are proving their value in generating very good income. Thank you, Bobby. Over the past 5 years, we've actually been able to generate income, believe it or not, from volatility in the markets. There's tools that will actually create cash flows because of the volatility. Now, by the way, when stock prices do come down, we don't hate stocks. I love stocks, just not at today's prices. But we've been able to use that volatility and increase your spending power that you have. I know, Wayne, you guys started taking some of that money now, the income. And that's good. That's really your spending power. There will be fluctuations in the capital, but it's how much stable cash flows can you get? And we encourage, spend the money. We want you to use, a lot of advisors are, well, you know, that you might need it for long-term care or something. Who cares? You know? Do what you want to do. Use it. All of us today statistically are in the best health statistically than we're going to be in. So do what you want with it. And by the way, our job is never to tell you what to do with your money. We just encourage you. We want to align your resources with what your vision for how you want to live is. So with that, what was the last one? Oh, it creates the opportunity for sustainable, and we do feel we're going to be right back in a declining interest rates. With that declining interest rate environment, watch what your portfolio structure does in the market value. Everybody's going to want that kind of income that you have. That's when people start flooding there. And then the stocks come down, we get good buys. Maybe historically, from stocks, prior to all the government interventions, we would get 5-6% dividends from the companies. That's the share of the profits. And now, compared to 1%, so we'll be buyers again, not at those high prices.